turn the call over to our Vice President of Servicing Relationship Performance Management, Don Griffin. Don?
Thanks, Baha. Hello, everyone. Thanks for joining us once again for this servicer information session. Over the past month or two, there's been so many questions that we haven't gotten to. We thought we'd do a little change up today, and the focus of our call will primarily be answering your questions. So to start it off, I'm going to ask Sujatha if she has any questions that were submitted last call that we didn't get to that we could start with.
Absolutely. Thank you, Don. Actually, the first question is going to be for you, so don't go away. Can you give a brief update on what are some of the scorecard impacts as it relates to COVID?
Sure. So initially, we were thinking of excluding COVID-impacted loans from the default metrics, the non-performing loan metrics on the scorecard. However, due to the very high volume of COVID-impacted loans, we made a determination that we're better off leaving those in. So we will not actually make any changes to the scorecard because of COVID-19. Impacted loans will be in the metrics, in the synthetic, et cetera, so you won't notice any changes whatsoever.
Thank you, Don. Our next question is for Ben, our Director of Servicing Policy. Ben, I want to make, we had a question from Cindy at United Bank. I want to make sure that I'm understanding the MOD program after July 1st. From what I understand, that any loan that I put into a COVID-19 deferral prior to July 1st, I can still offer the extend mod, but after July 1st, I can only offer a flex mod?
Oh, sure. So, so let's be clear. So I know it gets a little bit tricky because payment deferral is not necessarily a modification, whereas the extend mod and the cap and extend mod were mods. So yes, to an extent that is correct. After July 1st, the only modification will be flex mod because the other two disaster mods will be replaced by the COVID-19 payment deferral, which again, we don't consider to be a loan modification because it doesn't permanently address any of the terms of the mortgage. It takes the arrearages and it places the amount in a non-interest-bearing forborne balance or balloon due at maturity, payoff, whatever comes earlier. So if you do have a borrower coming off of forbearance or otherwise is able to resume making their payments before then, before July 1st, and the borrower was current or less than 31 days delinquent at the time of this event, which would have been March 1st of 2020, then you can offer them the extend or the cap and extend mod, which would then require the 3-month trial plan and settle the mod, or you can go to the flex mod. This again assuming that the borrower is not able to reinstate or complete a repayment plan. I think it is worth noting that typically the borrowers who are coming off of forbearance this quickly are the type of borrowers who generally will be able to, not in large numbers, but they will be, the type of borrower who's going to be able to reinstate or do a repayment plan is probably the borrowers coming off of forbearances, this early. But if not, then we do have the extend and the cap and extend. If they do come off by July 1st, that would be replaced with the payment deferral, which again does not require, if you've been on these calls, you read the bulletin, you've heard all this before, but doesn't require a trial plan. You can immediately move into the payment deferral. Settle it with us, change it, do the forbearance, and we're done.
Thank you, Ben. Baha, do you want to open the line for Q&A?
Yeah, sure. Let's go ahead and take some live Q&A. So if you do have any questions, go ahead and select the raise hand icon on the right side of your screen, and we will unmute your phone line. All right, looks like we have a question from Valerie. Valerie, your line is open.
Good afternoon. When the payment deferral is available in July, in the waterfall, if we have customers that are eligible, however, don't necessarily want the deferral option, are we delegated to then go on to the modification?
So the way our hierarchy works, you are supposed to go in order, and it's about what the borrower can afford. So if reinstatement, I can't do it. Repayment, I can't pay it. If you get the payment deferral, and the borrower says, no, I cannot, afford to make my contractual payment, then yes, you would move right into the flex mod at that point, and do the full terms of the flex mod, which, depending on I think everyone understands the flex mod has a number of different levers, depending on LTV and targeted payment reduction, but you would start pulling the levers, extending the term out to 40, potentially adjusting the interest rate and reducing the payment, and hopefully to a position where they can afford it.
Yeah. So let me clarify what I'm asking. They are eligible in the waterfall for the deferment. However, we've had some customers that have expressed concern with the balloon at the end of the deferment. So they may be a bit hesitant. So I just want to make sure that if they say, I'm not okay with that.
Yeah. So, and that's a fair point. Now, the odds are, too, with the flex mod, they probably will get into a balloon situation as well. That's how we grant the payment reduction, right? A lot of the times it's by forbearing some of that principal into a balloon. Now, if you do have a borrower who does state that they can make their contractual payment, but doesn't like the idea of the balloon, we can, and I'm going to put her on the spot a little bit, but just to confirm, Shuba, please weigh in. But you can submit to us non-delegated the ability to do a cap and extend mod. So we are eliminating outright the extend mod. That is gone for COVID-19. And we'll keep the cap and extend mod path, or not, it's not really a path, but we'll keep the product available on an exception basis beyond the July 1st date.
Okay, thank you.
Shuba, is that correct? Did I say that correctly?
That's correct. Yep, that's correct.
Thanks.
Great. Next question comes from Eric. Eric, your line is open.
Hi, good afternoon. Thank you for the opportunity. I wanted to talk about the position to not include forborne T&I payments in the deferral and the possible negative borrower impact from payment shock when the loans are reanalyzed. And the borrowers were told they'll just push the payments to the end, but now their payments are going up. And it may be that the only option is to then go to a modification to get them to a payment they can afford. So perhaps we could add the new escrow advances to the deferral amount as a solution for the borrowers. I don't know if you've thought these through.
Yeah. Hey, Eric. So, yes. So first off, as anything that you've actually advanced, right? So anything that has been advanced has been paid out, it can go right into the deferral. I think what you're probably referring to is the shortage, right? Meaning they haven't funded their escrow account some of these months. And no, that cannot go into the deferral. Just to kind of throw for everybody, if you haven't heard me say this before, it's not mortgage debt. You cannot add new debt to the mortgage balance. It's not a modification. It's not a payment deferral. It's a new loan at that point. It is not mortgage debt. What allows it to become mortgage debt is you actually paying the amount on behalf of the borrower. Then it can become mortgage debt under Section 9 of our security instrument. I'm sorry that I know that it's Section 9 of our, the 16-page uniform security instrument, but it is Section 9. And that's what allows that to happen. So we cannot include that in the balloon. So one thing that we decided not to do is we decided not to mandate that a new escrow analysis would have to be done prior to approving the payment deferral for the borrower. Typically, with like a mod program, we require an escrow analysis to ensure that you're not going to set them up on a new payment. Then 2 months later, their payment's going to change because of the escrow analysis. However, if you are concerned with that with the borrower, I would suggest that you do an escrow analysis right up front so that they know what the payment is going to look like to really be able to test affordability. But we're not mandating it because, frankly, it's an imperfect solution to mandate it. I mean, if you're in month 10 of a 12-month escrow cycle, it's a really good idea to do it now. If you're in month 2 of a 12-month escrow cycle, probably doesn't need to happen. Right? The difference is only going to be a couple bucks when you spread it out eventually. So we didn't mandate it, but it's probably a best practice if you're concerned with that with your borrower to do an escrow analysis.
Oh, understood. But once the debt is incurred, say, for instance, tax disbursement happens a month after the deferral is set, can we not amend the deferral to include the escrow advance?
That is a really good question.
I'm just thinking about the PR aspect to borrowers about the payments going up.
Mm-hmm. Eric, so we've thought about this as a, kind of the one-time solution, bringing the borrower current, focusing on what the mortgage is, not the escrow is. So I think there's some thinking, so that's something that we'll bring up with our regulator and conservator and the other GSE. We do all the stuff in alignment, whether we need to, to amend for those types of situations or whether we can deal with those via exceptions. I don't have an answer for you at this moment.
Okay. Thank you.
Great. Next question comes from Erica. Erica, your line is open.
Good afternoon. I jumped in a little bit in the middle of a conversation with regard to the anything after July 1st. The only modification will be a flex mod. Now, if we've had people who have requested a 6-month forbearance and that comes to an end after July 1st, does that mean that we would go right to the flex mod for them?
No. You would still go through the hierarchy. What is changing on July 1st is the hierarchy as it looks today is 6 items, right? What I call 6 retention items, and it goes reinstatement, followed by repayment plan, followed by our normal payment deferral, which actually doesn't start till July 1st either, now that I say it, which is not really going to be applicable for these borrowers anyways, followed by the extend mod, followed by the cap and extend mod, followed by the flex mod, right? So you got that. It's reinstatement, repayment plan, then 3 mods in a row. On July 1st, what the hierarchy will look like is reinstatement, repayment plan, payment deferral, flex mod. So the payment deferral is replacing 2 of the 3 mod programs, and that was the design of the payment deferral. It takes away the weaknesses of both of the individual programs and replaces it with one program that doesn't require a trial plan, it's not a modification, so it likely doesn't require it to be recorded, and and then so you're able to move the borrower straight into that, again, with being able to capitalize all the past due amounts and the escrow advances, not storage, but the advances, but also not charging interest on it the way the cap and extend mod does. So, I felt it was a really good solution to replace 2, frankly, imperfect modifications.
Okay, thank you.
Great. Next question comes from Maria. Maria, your line is open.
Hi, yes. Mine is kind of a 2-part question. So it sounds that, like, according to the guide, we can submit a non-delegated case for the payment deferral on loans that were already delinquent prior to March 1st to obtain approval. So my question is, can Freddie Mac share what you would be looking for considering when approving these cases, being that we're not necessarily asking for financial information from the borrower at that point? And then number 2, if it does get approved and let's say the loan was in foreclosure, can we include foreclosure fees and costs into the deferral amount?
So I will answer part of that, and then I'll ask Shuba to answer part of that as well. So the part that I'll answer is not about what we're looking for, because it's Shuba and her team that's going to get the request. But I'll, just a little bit of background here. The reason that it's the way we bifurcate it in terms of delegation is really based on the borrower who had no issues, who's always able to make their payments until some type of major catastrophic event that has impacted our country as a whole. 40 million people are now filing for unemployment. Major catastrophic event. Those types of borrowers generally should be able to make their payments going forward, hence why we can delegate it. On a borrower who's already missed payments, it does require us to think a little bit and say, is this the right solution? They've already shown they can't make the payment before any of this happened. So, I don't know what Shuba and her team are going to be looking for. I understand we're not asking for financials, so it's probably not going to be that. But the one last thing that I'll weigh in on is, look, there's always exceptions. But I'll say that if you're talking about a borrower who was already in foreclosure, I mean, they were already 4+ months delinquent prior to any of this ever happening, I don't think the payment deferral is going to be the right solution for them. Quite honestly, if they're able to do an affordable retention solution, the flex mode is very, it's a likely path. So Shuba, in terms of submissions, is there anything you can share of what your team's looking for?
So it's not any different than what we look for in any non-delegated submission. We really are not looking for any documents or anything like that. We basically want some kind of a write-up, a small comment that explains to us what was your rationale, why are you picking this option rather than picking a flex mod or whatever other option that we would have normally preferred. So what is so specific about this situation, right? Because it's an exception, we just want to understand what is it that is driving you to make this call. Does that help?
Okay. Yes. Thank you.
Great. Next question comes from Mark. Mark, your line is open.
Thank you. 2 quick questions. Any upcoming webinars regarding cap and extend mods? And where is Jack Henry on updating our systems to handle these balloon payments at the end of the loan? Any idea?
I'm going to look to somebody else from Freddie Mac on both of those questions. Sujatha,
so Ben, I can talk about Jack Henry. They have made lot of calls with us. I don't have an answer, but I can find out where they are. But they have had a lot of questions that we have answered, which would make me think their questions look like they were trying to make system updates. But I will try and find out, and somehow we'll communicate back to you.
Okay.
And for the mod program, the next 2, I'll get to the exact dates, but since the extend mod and the cap and extend mod are going away, the mod training is going to be on just the payment deferral and flex mod. I will actually keep taking the next question, and I'll come back and I'll give you guys the exact dates.
Okay, thank you.
Mm-hmm.
Great. Next question comes from Paul. Paul, your line is open.
I appreciate your guys' time, as always. Thank you. So just wanted to ask this question with regards to the timing. So we understand it here. And people that are in the forbearance for April, May, and June, their hardship hoping has been resolved, so they're ready to start resuming making payments July 1st. Typically, Workout Prospector, and I'm not exactly sure how it's going to work yet, right, because we haven't had the training, and I understand that. It's not available till July 12th, but typically if we were to enter this into Workout Prospector, July 15th, they would put the first payment due date on this is having to do with your normal mods, your flex mods. You would have the first payment then be, let's call it September 1st. So not knowing how that's going to work, essentially my question is, for people who are in the program April, May, June, they have their resolved hardship, they're ready to start making payments July 1st. Are we essentially, I know this, we can start offering this July 1st, are we able to use this deferral for people that end June 30th, essentially? Hope that makes sense.
It does. Shuba, are you able to? So I think
yes.
what you're saying is actually normally that it would normally go to an August 1st due date, right? Because we're settling it in July.
That's correct.
The question is, do we have the ability to make it with a July due date?
Correct.
Yes, so WP is always able to settle backdated March, so it is based on the dates you enter. I will make sure that the training covers how to enter these June 1 payment deferrals, but there should be no issue you entering it with, and if you entered right dates, it would give you you won't have to go until September.
Okay, and then we'll just want to follow up. You know, if we can't settle this through until July 12th, I mean, do you guys see any issue with, you know, taking payments, you know, first week of July, you know, and then either kind of keeping it unapplied until we're able to, you know, process the payment correctly so that your systems have been caught up with our system? I hope that makes sense as a question.
Actually, this mod will settle right away. There is no separate, unless there were some huge UPB mismatches between us and our investor reporting system, this mod will settle that night.
Yeah, but we wouldn't be.
You're asking the question. Yeah, I know I think I know where you're getting at. You're asking the question of do you apply it and then do you worry about the investor accounting mismatch? In the event, I mean, realistically, in the event that it's not settled by the P&I determination date, I think is what you're trying to get at. And you know, so I don't know if John's able to weigh in on that one as well. John Felix, who heads our investor reporting and accounting. But I think the answer is, you know, ultimately the payment will be applied in the same way because it's the arrearage, you know, that's going to get put onto the back end. It's going to bring the UPB down so that we're following the normal amortization schedule. So actually saying that, it's a good question. It's a good question because I think you can do it one of two ways, right? You can either apply it as the July payment and then start the deferral on August 1, or you can wait for it. I think you do it either way. But John, do you have any thoughts?
Yeah, I'm just sitting there, you know, thinking through that, right? Because if we haven't, because I heard what Shubha said that, you know, we would settle right away, but if we don't settle it right away, because we're saying not till July 13th, and I think we need to kind of just think through that, and then make sure that we call that out in the webinars that we're going to have. We'll make a specific point to call that out. Like, what's the best way to handle that? And myself and Shubha will kind of talk that through and then make sure that we make that very clear to everybody.
Okay, I really appreciate your guys' time. Yep. I mean, you guys are so thorough, so thank you.
Great. Next question goes in regards to the Workout Prospector platform. Is a deferral treated as a B loan for the system purposes?
I'm sorry, is the deferral treated as a what?
B as in boy loan for system purposes?
So I'm not sure. You know, everyone has different systems, but I've always heard it referred to as well as like a UPB2 or B. Right. So it's the non-interest-bearing, you know, balance that will stay on your records until the earlier payoff, sale, or maturity. If you already have flex mods in your systems that have a forborne balance, it would be treated in the same way.
Got it. All right, next question comes from Rochelle. Rochelle, your line is open.
So I have a question about the unpaid principal balance. So when the customer's hardship is resolved and they've got 3 months of forbeared parent payments with principal, interest, escrow, we're moving all 3 of those into the unpaid principal balance balloon loan that's just sitting there to maturity. When we report that, do we report that as just one whole balance to you, or are we separating the amounts of principal, interest, and escrow?
First, let me, and Shubha might ask you, or I think Ryan's on now too, if you have anything to add. But just to be clear, because I know this was a topic of conversation earlier in the call, the escrow that is able to be included in the deferral is the same, or escrow or corporate advances or whatever the case may be, is any amount that you have already paid out, right? Any amount that's due under the security instrument that's able to be added as mortgage debt, which for escrow amounts means you advance the payment to the taxing authority or the insurance company or the MI, whatever the case is. That can be added into the deferral balance. If it's just a shortage, the borrower didn't pay that month's portion of the forward-looking escrow account, you cannot add that into the mortgage balance. It's not mortgage debt. It's not due under the mortgage. It's due under the escrow agreement. It only becomes mortgage debt when the borrower has fully missed the payment and you have had to advance the amount to the authority as required by the security instrument.
Okay.
But in terms of what you then submit to us of what the balance should be, I think it's all together, but I don't know if Shuba or Ryan, I don't know if you have.
I don't remember exactly how the screen is, but typically on all our March screens, the escrow amount is separate. So there's the P&I and then escrow. But again, the WebEx will show everything in detail.
Okay. All right. Thank you.
All right. Next question comes from Connie. Connie, your line is open. Hey, Connie.
Hi, thank you. I have two questions. The first one is, can we do a COVID deferral and do a flex mod thereafter to reduce the payment with the reduced, UPB after the COVID deferral? Is that allowed?
Hey, Connie, this is Ryan. So I would say, I think, if you wanted to if the borrower needs payment relief coming off the forbearance, then you would want to go straight to the flex mod. There really would be no reason to do a deferral first and then to do the flex mod. So you really would, and in that instance, if the borrower is saying they need payment relief, you should go straight to the flex mod and not do the payment deferral first. Now, conversely, if the borrower thinks they can make the payment and you approve them under our requirements for the payment deferral, or if some of the borrowers you weren't able to contact and you send them the proactive offer for the payment deferral and they accept, and then they subsequently are unable to handle the payments, then you can certainly evaluate those borrowers for a flex mod afterward. And in fact, we actually also issued some kind of special requirements for these borrowers who are getting the payment deferral, where if they then become 60 days delinquent within 6 months of getting a COVID-19 payment deferral, then you're going to send those borrowers a streamline offer for flex mod earlier than you normally would at 60 days delinquent. So, yeah. So, mm-hmm.
Got it.
Does that answer your question?
Okay. Yeah, that does, and that's actually that does answer my question. So you're saying that, say that after we defer the payments, thereafter they're unable to actually afford those regular payments and they do fall 60 days delinquent, then that's about 30 days earlier than a regular streamline eligibility, and they're able to streamline flex mod them at 60 days delinquency after a COVID deferral.
That's right. And then even in addition to that, if you were to contact a borrower who even maybe was current, you can evaluate them under our regular imminent default requirements if that's the case, and if they believe that they need the additional assistance. And payment deferral doesn't count as a mod, so it won't count as part of the 3 or more mods, and there won't be like a seasoning requirement where you have to wait a certain period of time after a payment deferral.
Got it. Okay, understood. Thank you. And quick question, second question. So to be eligible for a COVID deferral, they have to have been due for March 1st and current on March 1st. Is that correct?
They could have been due for February 1st as well.
Got it. Okay.
We do permit them to be one payment past due.
Exactly, because February technically has 29 days, right, in that month, so that makes them less than 31 days delinquent on March 1st when the pandemic was officialized.
Yeah, and actually even beyond just the February being less than 30 days, when we talk about delinquency, usually in the context of loss mitigation solutions, we go in increments of 30, and we define 30 days as 1 month. So even if it were a 31-day month, we would still only consider you to be 30 days past due.
Got it. So they could be they could have been due for February 1st in order to be eligible. Perfect.
Great.
Okay. Thank you so much.
So again, if you do have any questions, go ahead and select the raise hand icon on the right side of your screen, and we will unmute your phone line. Another thing I just got in the queue was kind of a lengthy question. Just hold tight. It's, I think, a three-part question. As far as the investor reporting on COVID-19 payment deferral loans, does the amount of non-interest-bearing funds have to be reported separately on the servicing gateway? And the second part is it still being reported as a P&I transaction with non-interest-bearing funds being reported at the life of the loan? And the third part is there going to be any future training on the reporting piece?
So this is John. So the first part is, yes, there's a separate field. It's part of our loan level file. So you'll see that in there. It'll be reported in that file, and you'll report that each month to us. I'm sorry, Baha, you're going to have to bear with me and maybe give me the second part of that.
Sure. Second one is going to be, is it still going to be reported as a P&I transaction with non-interest bearing funds being reported of the life of the loan?
So that, if I'm understanding that right, so each month you would report that as a principal balance to non-interest bearing, and then when that were to get reported, if you were looking to pay it off, it's a principal payment. If I understood what they were trying to ask there.
Okay. And then the third part is there going to be any future training on the reporting piece?
So Baha, I'm on for that. I can actually give just the training does include some portion on how to report. The two, for the earlier gentleman who also asked, the two classes for June are on June 18th and June 25th, and there are some seats still available. It's through our Learning Center, which is in the resources at the end of this deck, so we'll share that with everyone. But there are some classes on specifically the payment deferral and the mods on June 18th and June 25th. Thank you.
Great, thank you. We got a question from Brian. Hey, Brian, your line is open.
Yeah, good afternoon. We're just going through the hierarchy and what's required as far as, discussing with the borrower the reinstatement, repayment plan, all before we go down to the payment deferral path. And so obviously with the payment deferral, no financials are required. And so in order for us to, be in compliance and meet this requirement of, discussing the payment plan and reinstatement, are we needing to go through and, discuss financials, either verbal or stated financials to just ensure that they do not qualify for a payment plan? Or can we just go based off of, more of a general description of how payment plans work, that's going to require an additional payment plus, the mortgage payment in order to, present that option to them? Like, basically, how deep do we need to go to discuss and offer the payment plan prior to moving forward into the payment deferral route?
So I think on that one, it's going to be somewhat dependent on the specific conversation or communication between you and the borrower, but you don't need really anything beyond the borrower saying they can't afford it. Even if let's say the repayment plan would have been for a borrower who is greater than 90 days delinquent, which in order to approve the borrower would require a complete borrower response package. If you don't need the borrower response package to determine the borrower is ineligible, then we wouldn't require you to get it. So if you were just during the talk off with the borrower to have them communicate to you, I wouldn't be able to afford that. That would be enough.
Okay, perfect. That's what I was just wanting to clarify, that as long as we present the options as far as having a repayment plan available to them, and if they just say right off the bat that, I'm not able to qualify or make an additional payment, then we can go down and discuss payment deferral and then the FlexMod path.
Right.
Okay, perfect. Thank you so much.
Yeah, and think about it this way, two things. Number one, if we said you don't need to collect any documentation, but that you still had to qualify or verify the borrower's financial situation, how is that even possible? And second off, I think by even really kind of asking for that information, you're opening yourselves up to falling under RESPA's rules regarding a complete complete loss mid application or borrower response package. So, as Ryan just stated, these rules were thoughtful in that you can use the borrower stated availability of or stated affordability.
Okay, perfect. Thank you.
Great. And hey, John, I just want to give you a heads up. That second part of that question in regards to the P&I transaction, that does make sense. I just got to chat back. So thank you for that. Next question comes from Danielle. Danielle, your line is open.
Oh, yes, hello. My question regarding the escrow shortage. Flex modification permits the servicer to spread that shortage over up to 60 months to avoid that payment shock. Is there any thought to adding that process to the payment deferral to help alleviate that situation with any shortage?
I was waiting for Ryan to say yes, you can do that. But I guess I'll say it. Yes, that is. You're absolutely able to do that today in order to limit the amount of the shock. Yeah.
Will that be added to the description of the program at some point? Because I know our quality control people would like to really see it in writing, that we can do it before we do it.
So we can take a look at it. I mean, I think we did refer to the capitalization section of the FlexMod chapter, which would have that guidance in it, and then also our regular guidance, like outside of a modification, is really just a more high level version of the same thing. If you do an escrow analysis, we just say to spread the balance over. We actually just say several months, which we don't define. And if you were to submit as a question to us, we would say, yeah, you can do the same thing as Flex and spread it up over up to 60 months. So we will take a look at that guidance, both as relates to just a regular escrow analysis and this specifically. But rest assured, you can do it up to 60 months. And in the event we need to clarify that, we will.
All right. Thank you so much.
Next question comes from Deborah. Deborah, your line is open.
Yes, I have a question. If they're just coming off the forbearance now, but you mentioned the repayment plan to them and they weren't acceptable to that because their payment is already kind of high, in July, could you still evaluate them if they paid the June payment and evaluate them for the COVID ID-19 deferral payment? Can they still do that one, or are they just qualified for the regular deferral payment then?
No, they are very much still eligible. So one thing that, to make clear here, we did not make it a requirement that the borrower had to be coming off of forbearance in order to be eligible for the payment deferral. So they had to be current. We talked about current or less than 31 already in terms of eligibility at the time of the national emergency declaration. But in the event, the borrower doesn't have to be coming off of forbearance. So what that could mean, and we've heard this from a number of servicers already, given the exact situation you're talking to, is borrowers' forbearance. Even some may end at the end of May. They can't go into the payment deferral until July, as we talked about maybe 20 minutes ago. And, what they're having the borrower do is they're just having, rather than go through a trial plan and work towards an extend or a cap and extend mod, which of course we already discussed was, both imperfect solutions. What they'll have the borrower do is they'll have the borrower make that payment for the month of June and then flip them into the payment deferral the following month. Now, the one thing that I would recommend if you're going to take that approach is that when you're doing that and working with the borrower to say make your June payment, and then we'll flip you into the payment deferral so that you're fairly current, into July, is that if you're going to take that approach, do it while the borrower also place the borrower keep the borrower or extend the borrower's forbearance. I'm sorry, I said like 3 different words, but what I meant was extend the borrower's forbearance that additional month. So they're making their scheduled payment, but they're still under forbearance. And the reason for that is so that the borrower can still get the protections provided under the CARES Act, specifically as it relates to credit reporting.
Okay. I got it. Thank you.
Great. Next question comes from Diane. Diane, your line is open.
Hi, good afternoon. Last week we heard that absent QRPC, loans nearing the end of forbearance should not be auto-extended, let's say by 30 days. We've heard that Fannie Mae doesn't have an issue with auto-extensions when there's no QRPC. Has Freddie Mac changed its position on this, or any thoughts on that?
I mean, I'll be honest with you, I can't speak for Fannie Mae, but their policy is the same as ours. It requires either QRPC or, what's applicable by law, which would be the borrower's attestation. So, no, we don't. We do not allow. I just provided a situation where you do extend the borrower, but that's with talking to the borrower, that's with obtaining QRPC or the attestation that they're going to need it so that they can get into the future solution.
Right.
Neither one of us, within our policies, and I know that because we are aligned within our guidance, states that that you may offer forbearance without the minimum of the borrower's attestation under the CARES Act.
Okay, thank you.
So I can tell you that for us, that's very clear. And frankly, I think it's clear within the law. So I don't know. I believe you. I believe you. I don't know who you talk to at Fannie Mae. We coordinate our guide updates, so I know we're both on the same page policy wise.
Okay, thank you very much.
Great. All right. Next question comes from via chat. How do we, the bank, recoup the interest that is being deferred? We continue to send payments to Freddie Mac on the past due loans. However, the interest due to us is deferred. Would it just be collected when the loan comes due either from maturity, sale of property, or a refinance?
So it depends on the scheduled amount, scheduled interest, or any other advances. It depends on what the outcome is. So assuming, and I might have missed part of the question, but assuming you're going into the payment deferral when you do the settlement, as Shubha talked about earlier within WP, we settle it, we change the balance, we bring the loan current. As part of that process, you would be reimbursed or given a credit under the detailed adjustment report or the DAR for the amount that you've advanced. And we did list that. I know it's a very long bulletin on payment deferral, but it's right towards the end we talked about the reimbursement process for that. If you're settling a mod, it's the same path, right? You get the DAR credit at the time you settle a mod, and then if the loan ultimately does not reinstate or resolve itself, heads down into the foreclosure path, we do reimburse everything at the time of liquidation.
Great. Thanks, Ben. If you do have any questions, go ahead and select the raise hand icon located on the right side of your screen, and we will unmute your phone line. All right, again, looks like we have a question from Kim. Kim, your line is open.
I was just wondering if there have been any updates to the delinquent interest calculation for FlexMod. Because right now the Workout Prospector Guide says that you have to calculate it a different way than the CARES Act.
Yeah, so we are still, so we are still looking into that with ourselves, Fannie Mae, and our conservator regulator, FHFA, and specifically our lawyers. The question is, of course, the forbearance can't charge interest above what it would have been if the borrower had made their payments. The question is what happens to that post-forbearance should the borrower not reinstate at the end. And we have not made a determination of what that should be yet. Right, okay. It's open to legal interpretation, and we're just trying to make sure that the GSEs are aligned in that interpretation.
Thank you.
Great. Next question comes from Connie. Connie, your line is open.
Hi, thank you. I just got a message in from my manager. She wanted me to ask this. So the question is, will we get reimbursed for any advances we pay, for example, taxes and insurance, or will we wait until the loan gets paid off?
Yep. So Connie just addressed that a couple questions ago. So it depends on, again, if the loan. So I guess I also left out a couple things, right? So if you're doing a payment deferral, you're going to get reimbursed the amount that goes into the balloon, right? You're going to get reimbursed at the time of payment deferral. If it's a mod, the same thing. The capitalized amount is you're going to get reimbursed that, which would include the advances. Now, if the borrower becomes current because they've reinstated or done a repayment plan, obviously you're getting your money back as part of that reinstatement or the repayment plan. I missed that on the previous answer, and then obviously if it goes down to the liquidation path, you'd get reimbursed everything at the time of short sale, deed in lieu, or foreclosure sale.
Okay, perfect. Thank you so much.
All right, and Ben, in regards to the reimbursement information, do you know off the top of your head what guide bulletin number that is, where they can find that information?
Of course. It is Guide Bulletin 2020-15.
Great.
Dated May 13th, 2020.
Great.
We're paid to remember the guide. You guys shouldn't have to remember what's in all 19 of the guide bulletins we put out so far, but we are paid to know that.
Not 19, Ben, only 6.
I believe the selling side just announced Bulletin 2020-19 earlier. So, and I think I do want to address one thing while we wait for the next question on that topic, because I think some of these questions that you guys might have might be coming from the announcement that Fannie Mae made yesterday. They had updated a couple of their lender letters regarding the operational piece and the reimbursement piece related to the COVID-19 payment deferral. We obviously did not have an announcement yesterday because we put all of our information again in that aforementioned Bulletin 2020-15 in terms of settling with us as well as the reimbursement piece. So that's why we didn't have an announcement yesterday. Yes, we are different than Fannie Mae in this space. I believe Fannie Mae has said, and I think this is confirmed from some of your questions, that they're reimbursing some of those amounts at the maturity or when the borrower pays off. For us, we do reimburse that at the settlement.
Great. Again, if you do have any questions, go ahead and select that raise hand icon on the right side of your screen, and we will unmute your phone line. Sujatha, did you have that other question as well that came through last week's call?
Can't get myself off mute fast enough. Yes, but it was a question that was asked already, so let me go to another one. A slight nuance on an earlier question, Ben, but I think it helps to reiterate. Can a borrower opt for a deferral versus a repayment plan, even if they can afford a repayment plan, since a repayment plan may be several months versus a deferral resolving the DQ immediately?
No, I mean, if the borrower says that they're fully able to afford a repayment plan, then they should do the repayment plan. We have a lot of solutions. We want to help borrowers get back on their feet. We want to do all this, but we also, frankly, they need to repay the money. So we provide these other options like the payment deferral and the flex mod for people who can't reinstate their loan or can't do a repayment plan. They're not just, it's not just the way. It's for people who can't afford to repay their amounts through traditional methods. So if they can afford to make the repayment plan payments, that's what they should do. If they start and then stop, and because they can't, it turns out they can't, they're still eligible for the payment deferral. If they were eligible before, or even the flex mod if it comes to that. So it's not going to ruin their eligibility, but if they're saying that they can afford it, then that's what the right solution for them is. We know it's not going to be the right solution for the majority of borrowers. That's fine, but for those who can, they should.
That makes sense. Thank you.
Sujatha, do you want to go ahead and go over the resources that we have available?
Absolutely. So just scroll down to I think it's the second to last slide.
Sure.
I think. There we go. As always, we will send this presentation out with our weekly emails that go out on Friday afternoon. But I also wanted to just check in with you guys to show you we've added a new resource just last week, which I want to make sure that you guys have the opportunity to look at. So as always, when you go to the single family website in Freddie Mac, you can launch down and you'll see the code resource page. You click on servicing, you'll see all the great information about what latest happening. What I'd like to share with you this time is actually we've added a new training resources about how to transition after forbearance, and I have it open here. It's actually a PDF. Some of the questions you guys have answered today hopefully will be helped with this, which is basically how to report, how to understand the cash flow, as well as to understand what are the options. So it's a very quick read, but it actually provides you just a timeline as how we'd want you to report and to think about the cash advances and things like that. So I think you'll find it really, really useful. So I definitely recommend you guys go to the Freddie Mac single family page and take a look at the COVID resources to make sure you have this information. With that, Vaha, I think we can transfer back to Don.
Great. So yes, I do want to make a quick note. I think there was a few other folks that did have their hands up, but WebEx wasn't able to connect their audio with their name, so we weren't able to unmute their phones. So if you want to go ahead and just put your question in the chat if you haven't already, we will get back to you in our next session. So with that also, I just want to let our attendees know that we do have a quick survey that they'll find on the right side of their screen. They can just take a few moments just to reply back to the survey. Your feedback is greatly appreciated. And with that, I'll turn it back over to Don for closing remarks.
Thanks, Baha. And thanks, everybody, for participating in the information session. Another great series of questions today. I think some of them came close to stumping the panelists, which was great. I love it. Thank you. With that, we'll call it a day and look forward to the next call. Thank you.